Morning.
Good morning, Lane Jones, and good morning, all of our wonderful attendees. We appreciate you being with us this morning. Lane, this is a historic markets and mindset. It's only our second, but it's the first one that falls very close to America turning 250 years old. I think that is hallowed ground. I think despite real worries around debt, AI hype, politics, the U.S. still leads the world in markets, money, and innovation. So I think it's an interesting time to kind of have this conversation. I very intentionally put this quote up here from a gentleman named John Sherman. You know, I love my quotes, where he tells us progress happens too slowly for people to notice, while setbacks happen too fast for people to ignore. What's funny is that he's actually a golf coach. So for anyone who plays golf, that makes a lot of sense. I think the best way that we can describe our goal today, Lane, is expectation setting and also being thoughtful around. And it was actually one of the questions from one of our attendees, this idea of how do we focus on the future without ignoring what's happening now? And we do live in interesting times, as we all know. So I think today's goal is to walk through what 2026 has brought so far, the why
Right.
behind that to some extent, talk through the big storylines, the big risks, and just give everybody an appreciation on how we think it should inform portfolio construction and perhaps how you can set your own expectations to get to better investment outcomes. Fair?
Absolutely fair. Good.
Awesome. Good. So let's kick it off, Lane. I think we have hypothetical returns for a diversified portfolio. Tell us.
Yeah, look, if you are building a diversified portfolio of a variety of asset classes, you get contributions from those asset classes throughout 2026 so far here, right? And most people, the large cap U.S. stock market is the biggest component of said portfolio, and therefore it has produced pretty handsome returns. But I mean, big takeaway, you've got a 10% return on a diversified portfolio through 6 months. And I think clearly if we were backward looking a little bit further, you would see that it has been an extraordinary period of time for investing. And we can talk about why being diversified is important, especially related to some of these AI discussions, et cetera. But I think this is a great takeaway, for what has so far been a fantastic 26 on the heels of great 25, 24, 23. So,
Yeah. I think what sticks out to me here is that bonds have done a whole lot of nothing, but perhaps that's too surface level. I think the next chart is one of my favorites that I forced us to put in here because I don't think people appreciate that 10.7%, that's the S&P's return this year. It comes from somewhere. It's not magic. Why don't you walk us through what that is?
yeah, I mean, returns long term, the old Benjamin Graham saying that long term markets are a weighing machine, short term, they're a voting machine, like sort of sentiment. Ultimately, profits drive returns, right? And when you get these questions, which again we'll cover in a little bit greater detail about, like, is this a bubble? Is like et cetera, et cetera. This is profits. I mean, this is going to be a big theme of what I will try to express today is that profits are driving returns, and it's not all this big fraud on the IFCOM, although there's obviously some questions about how long the earnings growth will persist. But this is great. In fact, the price, you see the multiple is actually gotten smaller, right? Like what you would worry about in a bubble is the multiple just going straight up, like you're paying 50 times earnings
Think
because
about 2020, right? So in 2020, this was flipped on its head, something that felt a little like a sugar high. So fabulous earnings momentum is a reality in 2026. And let's just take a look here at the different sectors that we've come across. So this is again by sector through 2026. Our emerging markets finally making up some ground.
Yeah, I think the emerging markets trade is a little bit transformed by the idea that some of the real big chip producers, Taiwan Semi, et cetera, are big parts of this index. I think China and India are actually negative, which is, you'd think emerging markets would be driven by those two very large economies.
Yeah, I think that's fair.
But what you also see is small companies, which I think we have a slide on, is have been doing well. It's not driven all by Mag 7 large cap stocks. There's actually some diversified portfolios actually doing better than just a large cap stock portfolio.
So here, so you brought up the first point that I wanted to, that's kind of the third order consequence of this. We and a lot of folks would say own emerging markets to diversify away from what's happening in the US, which has been wonderful, but to kind of measure your risks. But emerging markets are functionally giving you a tech trade as well. How do you think through that?
Well, look, I mean, markets are market cap weighted, right? And so the biggest companies in the emerging stock universe are going to be the biggest drivers of returns. So I'm fundamentally fine with that part. But I think you're right, which is that the world's growth and where the world stock market profit is growing happens to be in all things related to this very transformative build out of this infrastructure. So I don't fight it. I think you're correct to sort of point out that perhaps it's less diversifying than it was maybe past, right?
Okay, fair. And I'd get in trouble if I didn't ask. What about Bitcoin, Lane?
Look, volatile, right? This is if we do have some questions about, the deficit and reserve currency and all this other stuff, which I think we're going to chat about a little bit later. But if you want a screaming reason why Bitcoin is not going to become the reserve currency and the dollar is going to fall apart, it's because, imagine if what you're buying is your dollar is worth 33% less, like in 6 months. So
Well played. Well played. Here is as we move along, here is our slide on small caps finally doing something and outperforming their large cap neighbors.
yeah, this, it's been a story of large US predominantly tech-driven businesses over the last, sort of post-COVID period, if not even longer. Just absolutely printing money, fantastically run companies. They're transformed a little bit now in this new AI world. But what's the takeaway here is that the smaller rest of the market, so to speak, where lots of US capitalism is being done, are actually having a bit of a resurgence. You could argue there's a couple of reasons for that. Maybe the profit making is broadening out, but also maybe some relief in terms of shorter term interest rates are kind of helping those returns. So.
Yeah, we have a chart on margins and margin expansion coming up where I want to spend a little bit of time talking through how it's finally shown up for small caps. So you made a good point when we were chatting that those small caps are generally more indebted than large caps. Those debts are floating rate. SOFR is the one that it's pegged to, so perhaps that's where a little bit of the relief is coming from.
Yeah, I think you're right.
Okay. So here, look, here we have one that I was surprised to see, and again, we're in this every day. I didn't appreciate these drawdowns happened this year. We were kind of looking at it a little bit surprised. I think you fact checked it even. I think we agreed this was most likely just Iran, right? But we still have these wonderful returns. And look at industrials, kind of the AI trade in a different fashion.
Yeah, there are segments of the market that drive returns. There are segments of the markets that lag. This is why you don't try to be a sector specific only investor or only tech. I mean, I guess tech would have been fine in this particular period, but and I think the drawdown part, as you mentioned, we started the year sort of well, and then we gave back some money with some of the volatility with the Middle East flare-ups. Um, but this is very normal. If anything, it's a great talking point that pullbacks happen. They ultimately, depending on what's causing them, they generally don't persist. They tend to be idiosyncratic. But yeah, we've got lots of breadth in terms of where our returns coming from. They're coming across a wide space.
Let me ask you this. So industrial tech, energy, and materials, real estate, those are the top pieces of the ones that are outperforming kind of your base S&P 500. I
Right.
think we could all make a case that that's AI and that's the tech and then the infrastructure and the spend. Which of these would you kind of, if you had to perhaps order them, most sensitive to least sensitive, how would you think about that?
Energy, is a very volatile asset class based on energy prices, right? So to some degree, that energy is influenced by geopolitical stuff, right? So I might be a little bit more cautious just about whether that's long-term go-go. We do know that we're energy constrained in terms of the AI capacity thing, and these are industries that are often regulated, right? So as on the whole, that's probably the one I would be throwing the dart at it and say, like, boy, that's the winner. I think the build out and the infrastructure and the plumbing of what is being built is seeing material profit gains, something, we've got some slides up, but
Okay. Yeah, and we'll hit on it more. I just think that's kind of the glaring item here. It's
I
the
mean, the
CI
tech
piece and
trade,
then what's most sensitive.
yeah, the tech trade is probably irresponsible for me to not mention that Saskopoulos, like that there's some fear that the software elements of the whole tech sector are in sort of existential risk.
Okay.
So that's something that investors are sort of cautiously watching.
Okay. Let's pivot here. Let's go treasuries. Let's go yield curve. It's changed. Good, bad, better.
Now, look, if you have a diversified portfolio, it's not just stocks, it's also bonds. Bonds are influenced largely by the Treasury, the Fed, and the interest rate expectations. What you see is a year ago, shorter rates were higher because the Fed had not started cutting. Now, not surprisingly, the Fed had been cutting, since a year ago, and so those rates are lower. And what is interesting is that now longer rates are actually higher, right? And so, I think that is, we have some conversation about deficits and debts and all those other things. The longer end of the interest rate spectrum is dominated by inflation expectations, and the short term is obviously dominated by the Fed. And I think the market is sort of pricing in the idea that we're probably in a higher inflationary environment for longer. It doesn't mean hyperinflation; it just means slightly higher than normal. Is perhaps and it also ties again to deficit spending and the like. Here.
Yeah, I think that's where it's at. I think what was interesting the last two times that it was Jerry Powell decided to cut rates, the 10-year actually went up. And that was what I think at this point pretty well classified as the bond vigilantes telling the US, hey, we don't like that. You're not taking this seriously, and we are. So you quite literally had the short end coming down, the long end flying up. When Warsh first spoke on July 1st, he said, forget your forward guidance. I'm going to spend 15 less minutes talking than everybody else before me has ever done. And the bond market actually responded by coming down.
Right. Yeah, I look Warsh's approach to being less transparent, is a reversal of something that's been around since Greenspan, in the 90s, the old briefcase that he carried, which was indicative of what they were going to do. Um, it's an interesting experiment. Basically, I think what he's saying is let's let the market be the determinant of rates and let's not be sort of manufacturing and manipulating them. He's got some other ideas about reducing the balance sheet and other things. But on the whole, it's an interesting idea. Let's see, how market forces. I generally am a free market guy. So the idea that the market determines the value of things in it without government intervention, and that can take many forms.
Yeah, I like that too. I don't dislike how he did it. I don't know how I felt about him kind of walking in, but now that he's had, again, a month under his belt, whatever it is, I like the idea of a free market. This is a little bit of a projection, right, of what the market's saying the Fed funds rate is going to be. Correct me if I'm wrong here. I think there are two hikes that are priced in for 26. Is that right?
Yeah, well, depending on what happens this morning, right? Like they might be
Well,
back
yeah.
when it come out, right? Yeah, but yeah, there was an idea. We had flipped this script where we were going to be a 0.5% cut, and then the market flipped to a 0.5% hiked. That was all sort of driven by the idea of this inflationary impact, that the circular impact that energy prices tend to have in things, even if maybe oil itself is less important as it used to be. But yeah, now the market still has sort of longer term out some measure of easing, even if there's a shorter term perhaps rise.
Yeah, that initial little bump. It feels like the two hikes might be a little bit overcooked. Again, I'm a market guy. I'm not gonna outguess that whole body. But I feel like with what Warsh is doing, he's not gonna have to actually move rates to get the outcome that he wants. But time will tell.
Yeah, I mean, look, I've always wondered how effective interest rate hikes are on something that's effectively a supply side shock. We saw it in COVID, right? Like, is a higher interest rate going to get you more barrels of oil? Probably not.
Yeah, exactly. And I don't know, hiking into high gas prices. I'm not sure how that does much of anything. Um, so we brought this one up just because it's always historic when you get a new Fed chair, Kevin Warsh being the new one, replacing our friend Jerry Powell. We'll see how he goes down in history. What's this chart telling us other than things usually go well unless you catch, yeah, you pointed out, right, the 1987 crash?
Right, right. Good old Greenspan had a tough stretch of it. Bernanke didn't have an easy job either, although he probably got started before the crap hit the fan, figured so to speak, in 2008. But yeah, look, there's a long history of very, very, very intelligent people in the Fed that have done a pretty extraordinary job, notwithstanding maybe missing on inflation in 2022 would be the sort of the big black eye. And we're rooting for Kevin Warsh.
Yeah, yeah, we absolutely are. Paul Volcker, 7 footer. I don't know if you can see. I got a photo behind me. That's him smoking a cigar while he's being deposed or whatnot by the Fed. So times have changed. Happy 250, Paul Volcker. Earnings. So look, we already mentioned it. Fabulous earnings momentum. It's not a sugar high, unless who knows if Anthropic and OpenAI go bankrupt. We'll see how happy Amazon and Microsoft are. So earnings, Lane, they look real. Tell us more.
Yeah, well, real is the exact word. Look, this is the moment where we maybe morph a little bit into something that I think is the thrust of the talk today. That look at that right hand upper bar and look since 2022 and look at the trajectory of profits on the S&P 500. And you can maybe contrast that with the other lines, which are smaller companies or middle-sized companies, et cetera. But why has the market absolutely ripped 85%, in the last 5 years? That, right? We went from $200 per share in earnings to 307.
Yeah.
Do that, markets go up. They're supposed to.
What could go wrong with this? And it kind of plays off of this next slide, which is now forward earnings is are analysts projecting hard to beat earnings that are just going to set us up for a bomb? Like how many times can there be a surprise beat? Because the number in itself doesn't matter. It's whatever the expectations are, and then did it do better or worse?
Yeah, I think you're right to ask the question of where are the risks? The risks are clearly that the not only are the profits good, the expectations for profits are getting bigger, right?
Exactly.
309 to 370, backward looking 12 months, forward looking 12 months. That's 20% profit growth, right?
Yeah.
Um, if you come in at 15%, the market will rightly have to reprice to say, well, we missed that, but
Yeah.
that's not what's actually happening. And the slides we'll see in a second is they're actually revising higher. Like it's getting arrow up. It's not getting flat, right? So if that is wrong, and I think we'll chat about that a bit in terms of like what are the risks to the market or the AI construction uh, period. Um, that would clearly be the risk that these forward earnings estimates are arrowing up. And they're pretty good at, I guess there is always enthusiasm, but analysts and company guidance have gotten pretty good about not about trying to hit the mark without big disappointments. They do happen occasionally, of course, but
Well, absolutely. They've been doing this for a while, and 75% of the time, S&P 500 companies beat earnings. Like it's almost like a science. They're projecting S&P earnings increase 19% this year and 18% next year, which are big numbers. For me, the thing that this chart does a pretty good job showing you, but I just want to point it out. I'm not sure if my mouse is seen or not, but the trend for earnings on the mid cap and small cap is finally showing up. To
right.
your point, how much of that is I'm deploying AI versus SOFR, right? My cost of borrowing has come down a little bit. I don't know
Yep.
that it matters as much as the trend, which perhaps led to that nice spike in small caps.
Yeah, look, I think that we've had sort of a flat earnings environment in a lot of the market. And in fact, a lot of the questions we have gotten have been about like, hey, this is a really narrow market. It's focused in a couple little things, like it's all a bubble fraud, whatever we want to call it. And I think that says a different story that the market is actually broadening out, right?
Yeah.
Yeah,
So here
look
you
at this. I
go.
mean,
You got
earnings growth by sector, 40% tech earnings,
Yeah.
right?
And this just so you know, we have this is past, right, over the next 12. And then here's your forward earnings revisions by sector. So to your point, the better is only getting more better. as one would say.
They're arrowing up, right? And you contrast this with sort of maybe that 2000 period where which everybody sort of seems to compare this to. These are actual profits. This is you'll hear me say later that this is an earnings bubble, not a stock price bubble. That would be the question.
Okay, fair. And let's continue it, right? So this is now the trailing profit margins, which have continued to fly, and then your forward profits. Again, kind of telling a similar story.
Yeah, the big company tech stocks, which are a big part of the S&P, have had this magnificent advantage, which is that uh, they're software companies, they're cloud companies, right? They don't have a lot of cost, right? Like they literally were printing money before now they have costs trying to build out AI, but they have great margins just because their businesses are, they're not having to build factories and like buy steel and stuff, right?
Yeah. And so now let's talk valuations and how this plays into it because the valuation story is always going to be an earnings story. And while this is technically above historical averages, which by the way, couldn't we very easily make a case that it should be above historical averages given how profitable everybody is? If you ran this chart back in the early 2000s, late 90s, again, keep me honest here, these are in the 40s, right?
Yeah, yeah.
And then depending where you're looking, it'd be the 90s, depending being company specific.
That's because the profits weren't there, right? Like the whole market was pricing on the if come. And in this case, these companies print money. Like, again, this is backward looking, right? Like these are the Google businesses and the Amazons and the others have these very legitimate businesses or collections of businesses, actually.
To your
What would
point,
you sort of
here are
made the
the
point,
forwards, here are the forward valuations, just so you have them in front of
right?
you.
They're actually lower, right? Because the profits are growing into the prices. Um, what would I take away here? For a long, long time, you say, all right, the historical price earnings ratio on the S&P 500 is about 16 times. Wow, we're sitting at 23. If we look backwards, forward earnings haven't happened yet, so you always get a little cautious about them. And you look at the growth sectors of the market, and they're like at 25, 30 times, right? Well, that's actually the way it's supposed to be if you are delivering 20% profit growth. Like you can't have a stock that has 10% profit growth and a stock that has 20% profit growth, and they're both priced at 16 times. It's like free earnings growth. That just doesn't, the market doesn't work that way. So if you have 20% profit growth per year, which is what is anticipated, it should be trading at a higher multiple. But the
Okay.
challenge, obviously, just to maybe put a period on it, is if you disappoint, right? That's the challenge is that like when you have lofty growth expectations, if you don't hit them, then the market has to reprice lower.
Yeah. And here, so just to give historical context, we're looking at forward valuations by sector, identified at the bottom of each bar, and then it's 10-year average. And then what's interesting is a lot of these aren't really over their skis other than industrials, but has the underlying chemistry of industrials changed because of this build out? Or this is kind of perhaps a 10-year phenomenon while this build out happens. We're pulling forward returns, and it's not like I don't care how wonderful AI is, does it mean returns are higher forever?
No, yeah, returns certainly are not higher forever. I think you mentioned something people we sort of live and breathe, but pulling forward returns. Markets are pricing for expected future growth. And you can just see the obvious beneficiaries of where they think this build out in the tech space is going to be, and therefore they move in advance, right? The profits are expected to materialize. They are materializing now, but they're the real arrowing up and the compounding of profits is in the future.
Okay. Let's finish out this kind of broad level with a little bit of CPI and sentiment, and then we'll go deeper into AI spent. So this is GDP. Q2 expected for 26 is 1.2. 3 weeks ago, Elaine, that was 2.5, right? I don't know if there are tea leaves to be read there, if this is just a drag because of the import-export game.
Right. Yeah, I mean, what I take away here is that the economy is growing. It's not in recession. In fact, while you see some anomalies last year, the negative print and the big app, that's sort of tariff front running and sort of impacts of imports and exports on like the GDP calculation. And this is an economy that is growing, and certainly not one that has stalled. And quarterly can be, you look at the longer term. So
Okay.
I think these are positive figures, right?
Yeah, it's clearly positive. That negative print in Q1 25, that was just the tariff thing, right? Which again, kind of didn't come to pass. This one, I love this chart. It just talks about sentiment, but the reason why I love it is because it's usually a counter indicator to what the market is going to do over the next 12 months. And it's counter indicator, meaning if this is low over the next 12 months, you usually get higher returns over that period. So this chart is functionally useless other than in very, very high moments or very, very low moments. And this feels very low given what's happened economically, but perhaps this is a little bit of the K-shaped
Yeah.
thing that people are talking about.
I think you're right, which is that, like this idea of a K-shaped economy, that there are people that benefit from asset values because they're asset owners. They own stocks, they own a home, whatever it is. And then there's the group of people that perhaps in uh, maybe younger or lower socioeconomics that don't, and they get inflation landing on their head, right? I think if you were to say if you were to look at the economic environment and the consumer, you'd say the affordability buzzword is probably pretty influential in this. But I think you're right that when people are most pessimistic, it's oftentimes because they feel that things are bad and there's only room to go but up.
Yeah.
Versus when they're on a complete high, maybe everybody's a little over enthusiastic.
Yeah, this is just a crazy trend from 2019, 2020. Again, COVID happened. You get the highest inflation since most people can remember. And then you get this another bout of inflation and this AI piece. I think that the spokespeople for this whole AI thing need PR training because of how horrible Dario Amodei has kind of made everything sound and feel. Sam Altman is not giving that piece any credit. So the sentiment out there just feels bad, but you can't argue that economically most people are still doing better. One thing I look at is the a debt service ratio, which again has to do with interest rates, but this is when things are terrible. To give you a sense, a debt service ratio has to do with how much of your gross income per month is going to service debt. Obviously,
Mhm.
the higher, the worse. Coming into 2008, that was at 15.5. Today, we're sitting at 11.3. So there's kind of and it hasn't really moved much other than the move from 2020 to now because rates obviously went from zero to
Right.
something. So this is interesting. I'm excited to see what market does over the next 12 months, given that sentiment reading. Here's inflation. Again, the big difference there is energy. Again, it's July 8th today, so that memorandum of understanding doesn't seem to be too well understood anymore. So we'll see what happens with Iran and oil. But again, a lot of this is just oil. I don't know how hikes help that.
Yeah, I think you're right. I mean, what would you see here is that the inflation problem is not down back to 2%, core CPI. But it is not at the eights and nines it was, notwithstanding that little uptick in core because of, like you said, oil. I think that the reality of running a little hotter on inflation, 2.5 to 3, is probably in the cards. That would, as a long-term sort of investor, be sort of an interesting metric to watch.
Okay. And then last piece is really a little bit on the inflation story. It's just interesting to see how much of someone's wallet has gone to gas, right? And so while it hurts, it just doesn't hurt as much. How aware are people of this kind of feeling? It's kind of interesting. They will report on a sentiment survey that things are terrible, but then when you look at consumer spending, it's it's
Doesn't look.
gigantic. There's a reason why the pet care industry went from a $0 revenue business to a $600 billion kind of space, right? Because money had to flow somewhere. It's like water. So it shows up in spending, not so much in sentiment surveys. Here
Right.
we go, Jones. Let's talk about the elephant in the room.
Yeah, look, if we we obviously asked for some questions preceding this, and like we categorized some of those questions, and I think one of the ones that came through with some consistency is, is this a very narrow market driven by Mag 7, et cetera, and is that at risk? Is it a bubble, like prices can't continue like this? So there's this giant question about AI, like this AI enthusiasm. So we wanted to try to like let's make that our main sort of topic of the day here. What you obviously see here is just how enormous these big tech companies are. They're as big as, like seven of them equal to 433 of the rest of the S&P 500. There's, obviously some more in there, but
Yes.
um, this is interesting. So when you ask about the narrow, is this a really just narrow market driven by these big tech companies and it's bound to have problems? The answer is that this year, no. In fact, these big tech companies have not contributed much return. The argument would be is that they are being reevaluated because of the amount of money they are going to need to spend, and we'll look at that. This is the actual specifics of it, right? The 493 minus the Mag 7 are up 15%. The Mag 7 are flat, right? And the whole thing is up 10 at this point.
Yes.
So it's actually being driven by some breadth. And that was a question we specifically got. Is this a real narrow market?
Okay.
In fact, those big seven, as I mentioned, companies are being quite from they have different sort of individual stories, but they're being asked, like, hey, like you're investing a mountain of money. What's the profitability?
Yeah. So profitability. This chart illustrates just spending right now, trailing 12 months on this whole AI infrastructure build. It's supposed to get to $1 trillion before the turn of the decade.
Yep.
These companies that were in the business of printing money and their operating cash flows were ridiculous. I think you've seen the charts, and I surely have seen the charts that tell you all of that is kind of disappearing and the profitability is going to change. I'm going to complicate it for you on top of the fact that I'm spending on things that I'm depreciating over time. So I'm not realizing those expenses in a current year, which makes me look a little bit better than I usually would. And perhaps I'm going to have to replace that item before I even expense the whole darn thing. Right.
Look, I'm sorry, go ahead.
And the last thing, and by the way, I'm Microsoft and I'm going to give OpenAI cloud credits so that they can give me money that goes into my revenue. Talk to us about circular revenue.
Wow, lots to unpack in that
I
one.
know,
And
sorry.
it's probably the whole thrust of the conversation. Uh, circular revenues, absolutely a risk. I think at one point OpenAI had $12 billion in annual revenue. I'm sure it's higher now, but they had committed to buy $300 billion of compute from Oracle. Like tell me how that works, right? The good news is it's just sort of a forward agreement, right? In terms of the profits, you are absolutely correct that when we say earnings are driving things, and in particular in the Mag 7, the people that are doing the spending, you don't see their profits falling like and going negative because they're spending so much money, because just the way the accounting rules work, you actually take the expense of building the data center or whatever it is over a period of time, right? So you could argue that the earnings of these big Mag 7 companies in the future will have to pay for the impact of having to build this. The very, very big picture story in sort of maybe two pieces. This spend is real and it is buying stuff. This thing is being built. The AI, the whatever we're going to call it, the robot that's going to drive you around.
Sure.
It is being built, and the money being spent in order to build it is creating profit for people that are building it. Um, you and unlike the dot-com bubble, the people that are building it have businesses that absolutely print money. They're using their profits. Instead of buying back their stock, Google issued $80 billion in stock. These are businesses that have been buying back stock forever. They're issuing stock. Anthropic, OpenAI, they're rushing to go to market to raise capital. right? So if you're trying to make a bull case, or why is the market so enthusiastic, it would be that there is an enormous amount of economic activity that is being driven by the fact that this thing is being built. That's
Yeah.
real. It is not a bubble. It is not a fraud.
Yeah,
There are
good. So
profits.
let's do a little bit of a defining bubble, and I perhaps different people define it differently. It's obviously getting thrown around a lot because of the comparison to all these different phases. You had canals, you had railroads, you had highway systems. All of those historical events prove that you can have something be incredibly successful over a long period of time, while at some moment being a touch overdone where you end up with bankruptcies, where
Yeah,
someone is left holding the bag.
you're
You,
overbuilt, right? Yeah.
yeah, someone's going to be left holding the bag. And I think we have to hold two kind of competing thoughts together where we can say this can get overdone over a period of time, which pulls forward returns. Market returns come uneven. We have to deal with that. And it can still be a revolutionary new frame of infrastructure. The chart here, I think, does a reasonable job showing us a little bit of history. This comes from our friends Coatue. This is a company who's in the business of doing the impossible, right? They're trying to pick the winners, right? They're not doing the haystack game, they're doing the needle game. And more power to them. They framed this in a whole kind of mainframe to PC to networking and each iteration around all this infrastructure. And the founders of Coatue, as two Frenchmen who are usually pretty kind of emotional range is tight, 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 they're as excited as they've ever been with what they see coming, especially given that something that existed during the tech bubble, this idea of dark fiber,
Mhm.
true bubble, right? They were building something that there was no, you couldn't even create a future that existed for what they wanted back then. Right now, that's actually not true. What could go wrong is there's not enough energy, right? And one of these Anthropics or OpenAIs, people stop investing in them. If they stop investing, then there's going to be some dominoes that fall. We'll see what happens. Lane, I'm going to put something in here that we hadn't talked about, but I think it works perfect because of the circular nature. Private credit that
Mhm.
has come into this space and funded a lot of these kind of software builds out. And perhaps a lot of those companies were living in this 2015 to 2020 world of cloud SaaS is a thing, that's the future. And then by mistake ran into this AI thing,
Sure.
right? Which made everyone kind of a 10x software engineer. How do you think about the private credit asset class here?
Well, I when I see private credit, just at a very surface level, I say it's got a liquidity redemption problem, and then its investors are mismatched with the underlying asset class liquidity. I don't yet see a massive credit issue. People are still getting paid back. There are probably two very real sort of worries in that space. One is deals that were written before 2022 when interest rates were very low. The profits on those deals are not as high as the people would have wanted, and so therefore everybody's kind of like waiting around. And then two, there is this, like I said, sort of existential wonder about whether a lot of these software businesses that were bought and financed by private credit, whether those businesses will ultimately make it and pay you back. Those two things are absolutely very real. Um, I don't think the whole asset class is bad. In fact, I think that private equity business model, while it can tend to get over its skis with too much capital and then everybody runs. I think if you're a long-term investor in this space, which is what we're trying to be when we do bring dollars there, I'm fine with it personally.
Yeah,
Even if I do recognize it, yeah, there's always things that can go wrong and change the tea leaves on maybe the next 12 months or something. But
yeah.
we're not, I'm not terribly worried until I see credit problems.
Yeah, and for me, the takeaway simply is with credit problems, right? I don't think the private credit asset class disappears because of credit problems,
Right.
right? It's not a fad, it's an asset class.
Yeah.
So I think
Yeah.
like anything else, you have to own it like a disciplined, thoughtful person. So, and then even I know I kind of threw that out there. I thought it just fit in with the private credit piece and the SaaS piece. So I think what this chart is really leading us to is saying things change, creative destruction happens. This
Yes.
is another chart from Code 2 that's basically going to tell you the leaders tomorrow are not going to be the leaders from yesterday. right? That's one of the beauties of market cap investing, right? The indexes and capitalization weight indices kind of do the work for you. This includes obviously private companies on this sheet, but I think the big takeaway is functionally this idea of creative destruction, where I
Hmm.
think most of this idea around the jobs apocalypse is finally kind of behind us. And I'll have some recommendations at the end of our little chat today about somewhere to go look and listen that I found very interesting. But the leaders of tomorrow are not going to be the same ones today. Thankfully, and I think you'd agree with this, Lane, we're not in the business of trying to pick the winner. We're in the business of making sure we participate in those winners in aggregate being rewarded for their innovation over time. And then to bring this to kind of the public world, and I'll pass the mic to you. This is a wonderfully color coded piece that shows you basically every 10 years, half the top 10 changes.
Yeah, right. Which is especially in a world where innovation is being transformative. On the idea of creative destruction, people ask, should we just own the AI winners? And I say, like, that'd be great, if I knew. And I probably have said this too frequently, that it's the greatest argument for diversification there is, because who knew that Amazon was going to build a digital Sears catalog and Sears was going to be gone, right? Like, I mean, or that, as I often say, that Apple puts a camera in a phone and bye-bye Kodak, right? So I think it's a great argument for diversification, and the fact that a lot of the market portfolio construction is based actually skews towards the winning companies, right? Um, yeah, the leadership changes, and the idea, at a very, very broad level, the idea is that this will be a transformative technology that people that have talked to me recently probably will have heard this, but I think a lot about how in the dot-com bubble, uh, everybody was focused on the plumbing and the infrastructure, and the Cisco routers and the WorldComs and the telecoms that were laying fiber, and nobody saw all of the massive innovation that was going to be built as a product of that, plumbing. All the internet companies and all these things that like exist largely because this innovation happened. I think this innovation is going to be a large catalyst for growth, while it will also be destructive, and there will be losers. Um, and I think that's sort of the broader backstory I have. The one thing we didn't talk about that I think we should, before we close out sort of the AI bubbles, the amount of spending that is intended to take place to build the thing. The risk is that at any point in time, the people that are doing all this spending, their numbers change. Instead of doing $7 trillion, we think we'll do $3 trillion. Well, that's going to have, impacts that flow into, well, what is the profits of Nvidia? What is the profits of the memory makers? Because we were expecting X buy, and now we get some lower amount. That would be the risk, right? Which is that it is tied together. And what would drive that? Like, let's look at both sides of the coin. One would be we're not seeing the profitability as a result of the spend, which is that, I got so much operating free cash flow in my business that I'm not going to spend at this pace because it's just not producing profit, which is ultimately what markets will always ask for. So this trade will move, in my opinion, from the NVIDIAs of the world and the chip makers and all the hardware makers. Eventually, the profitability of AI, that earnings thing, that's why I say this earnings bubble, that the profitability on those businesses is not going to continue indefinitely in this like straight arrow up.
Yeah, somebody's margin is my opportunity.
Yeah, where the profit should ultimately move is the people making the investments, right? This is the people that will own the cloud and the compute. They already do. They're building more of it, your hyperscalers,
Yes.
right? So I think the profitability of who's winning now will have to change to the people making the investments. And how does that happen, right? So I'm looking sort of three into my crystal ball, like 3 years, 5 years out, right? The adoption by businesses of enterprise level applications to deploy AI in their businesses is going to drive the profitability of building it. And like our business, you know this,
I know. We're testing our AI CIO. We'll see how it
yeah,
goes.
we're going to have a $50,000 AI budget. Imagine that times 500,000 companies around the United States. That's where the profitability comes for these businesses that are investing. If suddenly the adoption is half that, or the price of the software is commoditized, and instead of spending 50, we wind up spending five, that's where the risks are. But I personally think, to put a sort of a finer point on it, that this isn't a market price bubble. It's sort of an earnings bubble because these companies are absolutely making mountains of money building because of the spend, and that will wane, and that it will have to morph over to profitability for the people making the investments. I think personally that will happen. I can't predict, however, whether or not they've got the numbers right. That the 7 trillion spend equals this dollars of profit. It might be 5 trillion spend that equals less profit. I don't know.
That's fair. I'm gonna up level this real quick with a touch of a pivot to the US versus not the US. Because in talking about this AI thing and the build out, that's a big US story that again other participants are not playing. But as it comes to portfolio construction and how we kind of view this and how we're doing this on a daily basis while keeping decades in mind, if you look at the US as a percentage of global economic output and then compare it to its market weight, right? So we're responsible for 25% of global economic output, yet we're 65% or so of the global index. In 2010, we were 42%. Again, do trees grow to the sky? How do we think about that in 2 minutes or less?
AI is being built here. Silicon Valley did it again.
Yeah, it is.
Profit growth. The profit growth is in the United States. Therefore, the businesses in the United States are worth more. That was under
That's
two.
it. So how do you, again, yes, just why have a 65% portfolio in the US? Let's have 100% in the US. Look, I'm leading the witness here. The obvious answer here is you have to approach this with humility. And how do you inject humility into a portfolio? It's the whole diversification thing.
You own the whole set. Yeah, I often say you don't buy stocks from A to M, although maybe now it's A to P, right? Like you buy it from A to Z, right?
That yes, it's fair. I just from an expectations perspective, the US market representing 65% of the index, excuse me, 42% of it in 2010. I think you have to be able to kind of conceptualize, well, you still want to own it, but it could very likely represent less of the global market over the next 10 or 20 years just because of the incredible run it's been on. It doesn't mean it's over, it just means it can be there. And then I'm going to bring that into for the folks worried about the US debt, our reserve currency status. And this
Well,
chart I pulled up here is still showing foreign buyers, both private and government, we're still the number one game in town. They're still buying our debt, a little drop down, and I'm sure that has to do with the president, whatever it is, but they're still buying our stuff. What we're looking at here, foreign holders of US treasuries, again, if there's something happening here, it's definitely glacial in pace, right? And then finally, here is the reserve currency status. So it's always a relative game. If it's not the US dollar, it has to be something else. We
right.
talked about Bitcoin a little bit just because we kind of have to for a second. Is it going to be China? I think everyone would tell you it's too closed of a market, right?
Oh, absolutely. Yeah, you can see there is a tiny share of sort of like reserve currencies. Um, and that these numbers have actually been largely pretty steady. Maybe you could argue in the 25 years that we've come down modestly because the emergence of some other currencies, right? Um, like even rewinding back to the prior slide about like two-thirds of the world stock market versus 40-50%, like a lot of that is the fact that the euro as an alternative to the dollar fell apart, with the whole pigs and the Southern Europe debt fiascos and Brexit and all these other things. So, what is the alternative? There really isn't one. It doesn't mean it's impossible for us to screw up, right? It certainly is. We're not shy about running absurdly high annual budget deficits. I'm a big believer in this. I don't really think there is a credible alternative as the reserve currency. Not that we can't screw it up again. I think ultimately that markets hold everybody to account. We saw that with Liberation Day and tariffs last year, is that when the cost of US debt starts to spin away from us, the people, the politicians, the people that are asleep at the wheel, and this is both parties,
Yeah.
will be forced into account.
Yeah. I think we definitely saw that, the bond vigilantes, which is always interesting. Everyone talks about the stock market, but the bond market makes folks a lot more nervous. So as an example, right, I think the global stock market is 80, 90 trillion dollars. The global bond market's like 300 trillion dollars. It's just like a bigger animal to deal with because there's just
Yeah.
more debt issued. So
Let
if
me,
it
let
is
me
a
answer a question
problem,
here from Dennis. Dennis, on that sort of, well, what does this imply
yeah,
longer term for bond markets and debt and interest rates, et cetera? I think the playbook, our Treasury Secretary has sort of advertised it, is that these large debts, which are worldwide, they're not just in the United States, but clearly they're sort of run away and they're starting to run away in the United States. Um, the implication longer term is ultimately higher long-term interest rates and a higher inflationary environment. That's, inflate your way out of it. The market will require you to pay more for your borrowings. And that's why we see the long end of the yield curve is creeping up because everybody's saying like, all right, there's an inflation element to this. We're gonna have to pay it back with cheaper, inflated money, right?
yeah. Right now, it feels like the best way to interpret this is that yes, there's a problem, but it's a decades-long problem. And since we don't have to find a solution tomorrow, and there has to be a credible alternative, there's an opportunity for us to make a pivot between now and 30 years from now. I'd be more concerned about personal economy versus global economy. I'm going to skip over SpaceX because it's SpaceX. It's all good. We get it. If you haven't read their S1, if you haven't read their market opportunity, it's kind of hilarious. They have an $80 trillion total addressable market. It's a fun read. A little perspective, Jones. We felt like we were going to be pretty optimistic in this. I think we kind of towed both sides here. This final chart, which is always the final takeaway, is markets move and they fall also, and you should expect any 12-month period of time to just deal with a 15% or so drawdown, just because that's how the water cycle or market cycle works.
Yeah, and I think irrespective of the regular expected drawdowns, I've been pretty positive about that. This is an earnings driven AI, market. You could draw a line from when ChatGPT was introduced in November of 22 to now, and the markets are just right. I'm not trying to say that they can't fall. They absolutely can. In fact, this chart says we should expect them to fall.
Yeah,
It doesn't move in a straight line. Inherently, this is all projecting forward, and the future is unknowable. And therefore, as those projections and consensus opinions change, it will influence markets. And so, in fact, it's unusual for markets to be on a run since 2022 to now. We should be very happy about it. I wish I could time it, right? Like I tell people all the time, we could have had this exact same conversation last year and we would have missed 20% before it fell. Like
yeah.
what you're worried about is the fall of 15, 20. You just got paid for it the past 12 months, right? So I'm not trying to say it can't revert. In fact, we should probably expect that it reverts because it's never a straight line, right?
It is 100%. On that, I want to thank everyone for having joined us. We almost kept the time here. We wanted to do 50 minutes. We're at 54. I wanted to end, Jones, on top of the thank you with a just a kind of quick set of recommendations from us. I'll kind of share my two. The first one is it's actually a podcast called Plain English, and the episode is called "The Case Against the AI Job Apocalypse." There's an economist on there. His name's Alex Emis, who's actually flipped his opinion on this issue, which I like and appreciate. And he hits on three kind of key ideas: idea of lump of labor, Jevons paradox, and the O-ring theory that are really just kind of good historical context to be able to, number one, have a conversation with your young kids, if you have anyone in college or just graduating college. And number two, perhaps for those folks who are feeling a little bit nervous around this apocalypse that may or may not come. I think the overwhelming evidence is it's not going to happen. Just like the radiologist. And the last thing, a book recommendation, it's called Strength to Strength for folks navigating kind of professional transitions and looking for that second kind of route to go, which is I know Lane is a big part of what we do on a daily basis. I found it to be a pretty thoughtful read.
Okay. Okay. I'm a boring guy. I put research on my nightstand and read charts and stuff like that. I do have a
We
gym.
just lost our listeners.
Yeah, totally. Well, if you want to read some really great in-depth pieces on the AI, Goldman Sachs has some dynamite pieces they put out. JP Morgan has a guy named Michael Semblist who is very, very good. They also they do podcasts too. So if you prefer to listen rather than have to read all this economic mumbo jumbo. So yeah, not an enthralling book recommendation or book club member I would be, but that's what I'm reading.
Very good. Lane, thank you. Everyone who's joined us today, thank you for joining Markets and Mindset. We appreciate it. If you have any questions, you can please feel free to email info@avensky.com. Obviously, if you're a client of ours, please feel reach out to your advisors. We're here to be helpful at every turn. Thank you again and have a wonderful rest of your day.
Thank you all.